Okay, let's just start financial accounting, and let's have a little bit review again, okay? Because this concept is very fundamental for our learning. So again, there are 5 major category, and each one will have a different sign for plus or minus. The debit side is always on the left, credit side is always on the right. And for the assets, just remember if the assets increase, we have the debit. If the assets will have the decrease, we have a credit side. Vice versa on the liability. And then for the stock shareholder equity, is the same size as liability. We have contribute capital, we have a return earning, and if we apply the same concept to the other account, the revenue gonna increase the equity. So the revenue is on the same size as equity is, and vice versa. Expenses will be on the same size as assets. So there will be eventually the expenses will be the most confusing part for these 5 category, because people always got confused. How come expenses is the same size as assets? It sounds like an opposite, right? Because expenses is compared to the assets. However, if we use the expenses gonna offset the revenue, the revenue is as same size as equity, then the expenses must be the opposite size of the equity. Then there's like assets. So that's the logic of everything. Okay. And again, here we have just putting in here. Okay, and this one is another slide we need to review over and over again. Those 5 accounts: assets, liability, shareholder, revenue, expenses. You can memorize them. There's no problem. But the tough part is you need to put the right account in the right place. Okay, so for example, for those people never learned the accounting, when they say revenue, they thought, oh, revenue is assets. That's totally missed out. Okay, so when you see the revenue, we'll do more revenue for today. Okay, for today we are gonna focus on the sales. Okay, so for those people they never learned the accounting, they don't have any concept. When they see sales, they see the money coming in, they always say, oh, revenue is assets. No. Revenue is revenue. Revenue made related to cash. Cash, of course, under assets. But revenue by itself is not assets. So that is one purpose for this class. As I said, even though we may not become the CPA or accounting professional, but in the future we're gonna use the same language. We can communicate with those people. They do the accounting for us. So remember like this: revenue is not assets. With the same token, expenses is not liability. Some people say, oh, liability equal to expenses. No. They're separate, okay? They are separate account, okay? So always keep this in your mind. There are 5 major category. But the tough, hey, Virginia, have a seat. But the tough part is we need to learn how to put together the account in the correct position, all right? So for example, cash is assets, no problem. However, revenue, have a seat. However, revenue by itself is another account, another category. All right, that's the thing you need to learn at the beginning. Always, you must keep this in your mind down the road. Okay. So again, okay, this chart is, I would say, is KB 2.3 in my book. I would say this probably is one of the most important chart for this course. Once in a while, you just take it out and just take a look at it and review it over and over again. I just cannot emphasize, more important than this. So revenue is not assets, okay? Expenses is not liability, okay? Just keep this always in your mind. So let's have a little bit review. Cash, okay? When you receive cash, no doubt that is assets, okay? But once in a while, we're gonna learn today. When you do the business, when you do any sales, probably for your company you did not receive cash. Instead of you have account receivable, or vice versa. When you buy something, you don't pay cash. Instead of you have account payable. All right. So account receivable is one type of assets, and we will talk about inventory today. Okay. Inventory is the stock, okay, you keep in your warehouse and ready for ship out. Okay. However, another very similar concept is called cost of goods sold. Cost, okay, come up with the same amount. Okay, when you do the business, when you do the sales, when you do the transaction, you may see the same amount. Okay, in the meantime, your inventory reduce. Inventory reduce. You can see that physically. You see the inventory reduce. We're gonna discuss that. Okay, inventory. However, you will match the amount from inventory, the value from inventory, to match the other account is cost. So cost is not inventory. Okay? Cost is on the expenses side. You see, the number one, cost of goods sold. Cost of goods sold. Alright? So again, I just give you the example. Okay? Try to clarify, some kind of very common misunderstanding. Okay, for those people that never learn accounting. So this chart 2.3 is very, very crucial for everybody. Okay, so let me see what else apply. I don't care about that. Yeah, let's talk about the prepaid expenses. Okay, and also on the second column you see the liability. Okay, you see the accrued expenses, and also very important, unearned revenue. Okay, so again, unearned revenue is not revenue. It's not revenue. So everybody still remember that? We want to do a little bit review. Okay, here. Say for example, on a certain day, your customer or client place an order with you. Just you received order, okay, on a certain day. And say for example the value is $1,000. Okay, say for example on the July 12th today. Alright. Your customer placed an order. Okay, placed an order. And the amount is $1,000. And for some reason, your customer just paid you cash right away. However, according to this order, your company will not be able to ship out and customer accept that. Okay, for 5 days. For 5 days. So, by the time when your company receive $1,000 cash, okay, Su Yuan, you want to try this? On the day your company receive $1,000 cash, however, you have not do anything yet. You just simply receive $1,000. How will do this accounting? This is from last session, which is more like a review.
Yeah. Okay. So
this is called unearned revenue, by the way. Okay, so go ahead.
unearned revenue, this cash, so still get into your asset. Right?
Yes. So you want to do what? You need to pick two accounts. So which account you want to pick first?
Asset. First.
Okay. Which
Take the
account?
cash.
Cash. Okay.
Yeah.
Everybody follow. Okay. When you come in receive cash, your assets increase by $1,000. So we have cash as the assets, and which side you want to put it in?
Yeah.
Debit side. Everybody.
Yeah.
Debit side. Yeah. Because on the first slide, right? When the assets increase, we have assets increase. So we have debit side. Debit side. Hold on 1 second, okay? So we have Virginia is here. We have Jin Chen, right? Jin Chen. So you follow, right? You agree, right? So when we have assets increase, we have a debit side, right? And so Jin Chen, you want to follow up. So you want to pick another account to match this transaction. So it will be on the credit side. But which account you want to pick?
Unearned revenue.
Unearned revenue is what type category?
Liability.
It's liability. It is liability. All right. So for this example, we have assets, debit, we have a liability, credit, then match. So we have a unearned revenue. So this is the liability. So we have the same amount here. Anybody can help me to get the eraser?
I'll do it.
Okay. Yeah.
Oh, maybe this.
This wipeout.
Yeah.
Can we use it? Is that on purpose?
Let me go ask Eric. You bring this one in. Yeah. Take a look.
Okay. So at least for this example, I hope Virginia, you agree this? No problem, right?
Yeah.
You're comfortable, right?
Yeah.
Good. Okay. So again, we're gonna use a few examples. Try to practice this concept more and more. Okay. Until the moment we feel this is part of nature. Okay. You don't need to think. Okay. You don't need to think. Once you make this as a nature, you can reduce the chance, to make an error, to make a mistake. Alright. So in this example, we have assets match with a liability. Okay, this is one example. Okay, how about follow this transaction? Okay, follow this transaction. 5 days after, your company delivered $1,000 merchandise. So Robert, do you want to try?
You said
5 days after your company deliver merchandise or service,
company, my company.
yeah,
Okay.
yeah.
I
It's
deliver.
business, right?
That business delivers.
Then at this moment you want to do what?
So from inventory, you're gonna.
There's a lot of account, but just step one by one.
Okay.
Yeah. No problem. You can look at the note. Okay, so
Yeah, I
open
have
book.
my notes here.
Yeah.
But still.
Everybody, this is
Doesn't
an open
help us.
discussion. Everybody, you want to come in, you want to participate.
Yeah.
Would it be cost of goods sold that you would?
Yeah, that will be part of that. But I would just want to simplify.
Oh, okay.
I want to go from another step first.
I think now you have revenue, right?
Yes.
Because you're already
Yes.
delivering.
Yes.
Okay.
Yes. I want to go from there.
Right. So
Make it simple. Yes, we'll go to cost of goods sold, and we'll go to the inventory later. Okay.
Okay.
But right now we want to simplify the whole thing.
so it's a credit.
Hold on. Which account you want to pick?
Oh, revenue.
Revenue, or you can pick up this account first. Either way.
Or
I don't
the
mind.
other side?
Yeah.
Right.
Yeah, because we're gonna close
You need
out
to
the
close
unearned
this one,
revenue.
Right.
Right. So we can pick up revenue. So right now we recognize revenue already. Okay. So again, revenue is revenue. Okay. Revenue. Do not mix revenue to assets. Okay.
Right.
At this moment, we do not touch assets yet. Well, but not yet. Not yet. So when revenue increase, it's gonna be on,
On the right side.
or you say
That's
credit side. Credit side.
Credit side.
Okay, we try to don't use the right or left. Okay, whether the right wing or left wing, we're not the
credit.
Republican or the Democratic. so try to use a credit side. Okay.
Credit
So we have
1,000.
yes. So about $1,000 here.
And then
So right now we recognize revenue already. Okay. Then to match this,
And
of course
earn-
we close this
yeah,
down.
you close that one.
Okay, everything here we are based on accrual method. Accrual method. Yeah, thank you. Yeah, I have one more. Good. Can anybody tell me why? Can anybody tell me why?
Why what?
Can anybody tell me why on the July 12th, the day we receive $1,000, why we don't enter this as revenue? Well, by the way, one step back, okay? In real life, if you do this, nobody can argue, okay? Because it's a mistake from the accounting procedure. It's a mistake. However, it's not a crucial mistake, okay? But again, I want to ask you why we should not go directly to revenue on July 12th.
because of the fact is the concept of when you recognize revenue in this day and age, the fact is when you actually ship the goods. I mean, if you, for example, if you're manufacturing gold, actually you can recognize revenue as you pull it out of the ground because it's a commodity that is easily sellable. But because of the fact is what's the critical issue in this regard is the fact is the shipment of the goods. If this was software, actually, there's an issue of software. When software is recognized, the concept is when you actually deliver everything. 9702 says you don't recognize revenue until all the things are shipped.
Yes, very good. Okay. Eventually, this is one topic I can suggest you for your final presentation. It's called recognition or recognition. Okay. When can you recognize it as a revenue? When? Again, if you're going to ship tomorrow on 13 and you enter into as a revenue today on 12, I think that's not big deal. As closer as possible, I think it's big deal. But 5 days, is that big deal? If 5 days is not big deal, how about 10 days? How about 30 days? Once you have more lead time, you see the problem there. Why? Let me tell you one issue, okay? As a manager, as an operating manager or operator, okay, you are the manager, okay? You want to please the outsider. You want to make your financial statement look better. You know what? You want to enter into as a revenue as quick as possible. Especially this is almost the due time. You want to turn in your report. See? Because you want to recognize this as a revenue, then you can show much better. Otherwise, this is going to show it as a liability. If you show this on the revenue, you're going to see you will see more net income for this period. So there's a temptation. Eventually, there is a temptation for manager. I want to show this $1,000. No, hey, $1,000 is not big deal. How about $1 billion? You just receive $1 billion order, and you have 5 days to deliver the goods. However, tomorrow is your due date for report, right? So if we as a manager, we do have the temptation, try to recognize this as a revenue as quick as possible. So I would say, well, if you want to please the Wall Street, your investor, we do have a temptation to report this as revenue. So the issue come out. To what kind of extent we do not violate the principle, the accounting principle, or simplify to what kind of extent SEC will not come in to give us trouble. Have a seat. Yeah, have a seat. You just sit there. So I would say this is one topic. It's not too far away. Okay, only 3 weeks away. 3 sessions away. Okay, you gonna come out here to do your presentation. So recognition is one of the topics you can think about that. Just as David said, okay, generally speaking, the day you can recognize this as a revenue is the day you ship out. It's the day you ship out. However, the day of shipping out still very ambiguous. How do you define? You are able to ship out. Is the merchandise sitting in your dock, and the truck almost coming in? Is that? Or you're pretty sure your merchandise is coming in this afternoon, and then you can ship out tomorrow morning. Can you recognize today or tomorrow morning? So that's still very ambiguous, right? But you know the fundamental issue. As a manager, we would like to report this as a revenue as early as possible. However, we know to some certain extent we might violate the principle. So what's the line? So I think you can do your online research. What's the principle for the recognition? Okay, it's the day you ship out already, you see the truck already go out, then you can recognize all the trucks coming in, still sitting on your dock, and you can recognize which timing is the final line, right? So just tell you why this is a conflict there, why this is incentive for manager to report this as revenue as early as possible, because we want our income statement look better. That's the reason why. All right, but we have not finished yet. Okay, so far, assuming on the 5th day we did ship out. Okay, we already see the truck left. Okay, so it's on the way already. We know. Okay, we deliver it. Okay, even anything happens, still recognized as delivered. Okay, and then we need to close this transaction. We have not finished yet, so we need to eventually. That is the topic for today. So after we do this revenue and unearned revenue, which account we need to do the adjustment, or say to do the
Inventory.
inventory match, which one?
Expense.
But under expenses, but what?
Good of-
Yeah, cost of goods sold. Cost of goods sold. We will talk about cost of goods sold today. All right. So assuming this is $800, assuming, all right, the cost is $800. Then, Virginia, you want to try it? We have 2 accounts we need to do. The cost is $800 value.
So you would debit the 800 to the cost of
So which account you want to pick first?
cost of goods sold?
What you want to do that is fine, but I would like to do inventory first,
Oh,
just for no reason. Just for no reason.
okay.
Inventory, we notice. So you see 2.3 escape, right? Inventory under which category?
Assets.
Assets, no problem. So when assets reduce,
You debit it.
uh,
Or credit it.
yeah. So we always know in our mind we say this is credit, but when we talk about it, it's debit, so this is why we need to do more practice. Okay. So when inventory reduce, yes, we have $800 here. Okay. Then cost of goods sold increase. Right? Cost of goods sold is there, right? Right? And also, revenue 1,000, cost 800. So by the end, we know there is a profit, $200 profit. But we don't need to calculate right now. By the end of the period, it will show us this $200 profit. So far so good, right? This is kind of review from last session, and we will do more practice for today for sales. That is our topic for today. Right. So same thing. If opposite way, if it's opposite, you are the supplier in this transaction. You sold to your vendor, deliver to your customer $1,000 first, but it's a 30 days payment. So again, okay, you are the seller in this transaction, in this example. You deliver $1,000 goods to your customer. However, the payment is 30 days. How are you gonna do it?
So accounts receivable.
Yeah, you can do either way, right? So you have a account receivable. So everybody account receivable under
Assets.
Right.
assets.
I was
Virginia.
going to say
Yeah.
liabilities.
Yes, just right. Yeah. So it's account,
Liabilities.
account receivable. No, account
Oh,
receivable.
Account receivable is asset.
Assets, right? Account receivable. Okay, we have account receivable.
He switched companies. He's actually the company
Yeah.
selling the goods.
Yeah. Right now we switch our position.
Oh.
Yeah, we switch. So everybody, right? We're on the same page, right? We switch position right now. So we are the supplier right now.
He
So
switched companies.
yeah, switch company.
She has done it.
Okay.
We're switching companies. What we're doing is we're talking about the selling company actually selling the goods to the company that's received them.
Right.
In other words, not the company that's picked up the revenue in this particular situation.
Right.
It's the company that's actually sold the inventory.
Right now, yeah, we switch all the position here. Okay, you are the supplier to this company, to our original company. So right now we switch position. Okay, so you are the company sold the goods to this seller. Okay, you are the up level, in the supply, in the chain of the supply. So right now we switch our position, you are the supplier to this $1,000. Okay, so you shipped $1,000 goods to your customer. So you deliver your goods, you deliver your service, but without a payment, without any payment. So right now you are the seller. So we have account receivable increase here.
800. You're
Yes.
confusing the issue again.
You got it right. Thanks. Switch here because it's not 10,000. 10,000 is the other company sold to the customer. So right now you deliver the goods is value 800 without any cash payment. Okay. So right now we have account from the standpoint of your company, you have account receivable increased by 800. So Yiqing, you want to match this 800 with another account. So the payment is net 30, right? So you have not received anything. So we have $800 here. However, you need to match this 800 as what?
No, revenue.
No, account receivable already. We have an account receivable already. You want to match this account receivable with another account which can show you 800 on the credit side.
Start with R, E, V, E, N, E, U, E. There you go.
Yeah, the fourth one. Revenue. Everybody, okay, if you have any doubt, we can pause for a few seconds. We can discuss this. Okay, you have any doubt? Because, for this example, it's totally opposite, right? You deliver your goods first. We don't care about the payment at this moment because assuming you will receive it. Assuming you will receive it later on, okay? So right now, for sure, no problem, you can recognize this as a revenue. I don't believe there's going to be any challenge or any argument here. Without any cash receiving, no problem, this is your revenue. You can please your investor very well because your company recognized $800 sales already. No doubt. Assuming your cost is 500. Okay, we don't need to repeat that again, but I just want to show you when you deliver goods, when you deliver service, even though any payment yet, they'll be fine. Recognize this as a revenue. Recognize as a revenue sometimes is very, very important for your business. For your business. The funny thing is, the investors, they are more interested in the number on the paper, not really the cash in your bank. This is kind of funny. But, this is how Wall Street running, Those people, they beat your price on your stock, not really care about how much. Of course, they care about that, but they more care about the number on the income statement. So cash is still not there. 800 is not there yet, but they will be more happy when they see $800 recognized as a revenue. The number is there already, and they can see the net income. If $800 is not there, you will not see net income on the bottom. All right. So for this case, no doubt. Okay. We have another example is accrue expenses. Accrue or the other way around. Okay, you prepay. So for example, still remember this example. On the first day of the month, your company prepay 3 months rent to the landlord. Okay. Just like our school, we just move here and we prepay 6 months to the landlord. Okay, so each month it's say it's $1,000. We just prepay $6,000 cash to the landlord, which gonna cover the following 6 months rent. So on the day one, we prepay 6,000 cash. Okay. So Ji-Chen, you want to try? When we company pays 6,000 cash to somebody else, so we have cash reduced.
It's credit cash.
Credit cash, no problem, right? Because assets reduced by 6,000, and we need to pick out another account to match debit 6,000.
It's prepaid expenses
So prepaid expenses under which category?
under asset.
Assets, everybody. Prepay. If you see some kind of prepay, okay, even though cash reduced, however, the total amount under the assets still keep the same. We just move from one asset to another asset. We move from one asset to another asset. So we have a 6,000 reduced amount cash. We have a 6,000 increase credit on the prepaid account. Okay. And by the end of the first month, we need to do adjustment. Say 1 month gone. Okay. So you want to try?
So then become the 1,000 of the first month's the rent become an expense.
Okay.
And then on the
Okay.
credit side.
Can you try to
Pay off.
use more accounting language to express? You want to debit credit? I want to hear
on
which
the-
your
on the
account
credit
debit
side-
credit by
credit
one
side
amount.
From asset on the reduce the debit side, and then the increase on the asset on the
Hold on 1 second. Which account you want to pick? Which account? The name of the account.
asset side. The
I know assets. Assets is a category.
Cash.
Name.
Cash.
No.
Oh, no, sorry.
No.
prepaid,
Everybody.
prepaid.
Prepare account.
Yeah, prepaid
Everybody.
account, yeah.
So when we try to use more accounting language, right? What I mean is you pick out the name of the account. So right now everybody agree, right? We pick out prepare account. Prepare account.
And
Then which
debit.
side?
Debit reduced.
No.
Oh.
Debit is not reduced. So again, try to use again.
Credit.
Credit.
Increase.
No, credit. No, just credit. Don't use
Credit,
increase.
yeah.
We know. We understand already. Okay.
Okay.
Credit by how much?
1,000.
Okay, everybody. Okay, if we try to use more accounting language in the future, we speak with accounting people. We say, okay, on prepare account, credit by 1,000. Credit by 1,000. We know credit means this account reduced by 1,000. So everybody agree so far? Okay. As I said, one of the goal for this class is we try to use the accounting language so we can communicate with those accounting professional. Okay, professional. Right? So we pick out prepare account. And in our mind, we don't need to speak, but in our mind we understand prepare account, that is one of the assets account. So we say we're gonna credit prepay account by $1,000. Alright? Then which account you want to match? So name the account first.
Expense.
Expense account, or you can even specify it as a rent expense, because we have so many expenses. Eventually, by the end of the year, we need to not by the end of the year, down the road, we're better off differentiate what kind of expenses, because when those people they need to file the tax return, they do not provide just one number. They must have a subcategory, for different expenses. So we say, okay, this is a rent expenses account, and then you have
Debit side.
debit side. Everybody must be debit side because we have a credit side already. So we have a debit on rent account, or say debit on the rent expense account by $1,000. $1,000. Of course, in real life, everything is in the software. For those people, they just key in the number. That's it. Okay. All right. So far, so good. All right. So with the same token, say for example, by the end of the month, we owe the salary, okay, to our employee, say $5,000. However, the payday is not due for another 5 days. Okay. So in order to close the book for this month, we need to recognize this expense. So Robert, you want to try it?
It would be the salary, wages expense.
Good, very good.
You want to debit.
Okay, increase, right?
Yeah, right.
Okay. Hold on 1 second.
He's
Yes,
right.
you are right. Right. Everybody follow, all right? Everybody follow. So we pick out the salary or wage expenses, right? And increase we have a debit. So by say $5,000.
Right.
$5,000. Everybody follow? If you don't understand, we can discuss. If you don't agree or you have confusion, we can discuss. But it is correct. Okay? It is correct. Even though, by the way, everybody, again, at this moment, no any cash payout yet. Cash still sitting in our account. We still keep cash $5,000. However, we can report this as expense. We can report these expenses. Can anybody tell me why, as a manager, you like this?
It puts the expense in the proper period. It
Then,
matches the expense with the revenue. It's a matching principle.
so the result is
It's in the correct period.
The profits are less.
right. Profit is why that's good. If you should eventually, I might be conflict, right? I still want to see the net profit higher and to please your investor. But how come here you want to reduce your net income for what purposes?
Taxes.
For tax. For tax, right? Because you can reduce your tax liability. However, in the meantime, you still keep your cash. You have not paid cash out yet, but so there's a conflict. Right? There are multiple purposes. One purpose is to please your investor. So for that purpose, you want to see higher net income. And there's another conflict, totally conflicting. Okay, you want to reduce your tax liability, then you want to reduce your net income. And let me tell you what, it is legal. It is legal. You have a different principle. You can even have two books as long as you keep consistently. Okay, one book to report for tax, one book to please your investor within the limit. Within the limit. Eventually, it doesn't matter it's legal or illegal. It's always been practiced for businessmen. Okay, in China, in Taiwan, we cannot have two books, but we do the same thing. We still do the same thing. Okay, in order to reduce all the tax liability, we keep one book. Okay, to show IRS, and the other book for manager, we can reflect. We can see what is the real profit. Okay, for this period. So at this moment, that's fine. Okay, we still keep cash in account. We have not paid out anything yet. However, we reduce our tax liability already. So let's take. You want to finish the other part?
Yeah, I think that the other part is liabilities.
Liability, very good.
And wage payable.
Wage payable, perfect. Wage payable. You can see anything payable under the second category. Everything payable. A lot of payable. Okay. Again, that is liability.
And credit.
Yeah. When the liability increase, we have a credit side by $5,000. Yeah. Okay. So next month, the 5th day of next month, we pay out $5,000 from our cash. So Virginia, you want to try this?
The next month you pay out cash, you said?
So we have cash reduced. So you want to use more accounting language?
So you
We have
the asset category and credit your cash, pay it out
by
by $1,000.
$5,000. In my case, it's $5,000. So we say, well, we credit cash on the day we pay out, right? We credit $5,000 on cash account. Okay. Yiqing, you want to finish the other part? You want to match this $5,000, and we know this must be on the debit side. Or anybody want to give Yiqing a help?
It's the accrued payable that you set up with accrued wages, as Robert used the term. So you got to get rid of it.
You close your liability account.
You tell Yiqing. Everybody try to help her.
So it's liability, right? Because that's the account that
He set up the liability. So what you got to do is, since you set up the liability, you're gonna get rid of it, and so you're gonna debit it. In practice, that's not what actually happens in practice. What we do is we set up the expense, and then what happens is we reverse our accruals, and then we just book it to expense in the subsequent period. In other words, if you have a salary expense and you accrued $5,000 to salary to expense, and then to the payable, what we do is reverse it out before the start of the period. And what happens is the expense, it goes as the dollars go to, that's paid goes to, it's booked as salary expense, but the credit is to It's just booked as a regular entry because we've already booked we booked the. God, my brain's not working.
That's fine. Yiqing, you want to try use your accounting language for this part? You want to, let me get a hint, okay? You want to debit what? You want to debit the name of the account? Debit what? Anybody can help her.
Wage expense.
You want to debit? No, we're done expense already. We need to close out the liability account, so you want to debit.
Wage bill.
Wage expenses.
Is it expense we already used?
Right, we done the expenses already. Yeah, we recognize expenses already. We need to close the,
Yeah.
Wage payable.
yeah,
Yeah.
Yiqing, we want to close the payable account. Payable account is only temporary. Okay? So, yeah, go ahead, everybody, try to help her.
Under
Okay?
liability, the expense already done, so it should be under liability. Yeah, wage payable. Right?
Yeah, let me clarify again, okay? Where are we right now? We are on the day we pay off this $5,000 payable because we recognize our expenses 5 days before already.
Yeah.
So we don't touch expenses account no more because expenses being recognized already, done already. By the day we pay off this $5,000 cash, of course, we need to credit cash, of course, because cash reduce, right? The day we pay out, cash reduce. So we credit 5,000 under cash. So we need to find out another account to have debit 5,000. Cannot be expenses because we've done expenses already. Okay, so it must be the payable. Must be payable because payable was on the credit side, and right now we need the debit side. 5,000, 5,000. Close this account because account payable. Eventually, everything payable should be the temporary. Should be temporary, unless you default. Unless you have a default. Otherwise, by theory we know everything payable means we obligate to do it, right? So we obligate to do it. It's only the matter of time. It's short time or long time, right? It's only the matter of time. So when we do the closing, we know we need to pick out the payable account. So that is the wage payable. Okay, Reddy just mentioned, right? That's a payable. He opened it, but you close it. Okay, by the time you pay out. Yes, go ahead.
Okay, so you mentioned that because we didn't read them on time, it's kind of
Not really on time because we don't need to pay on the day, the last month, the last day of the month because the 5,000 is not due yet. In the reality, probably your company is only pay, bi-weekly, right? So bi-weekly means probably you need to close your book for by the end of the month. But on that day, $5,000 is not due. However, you can recognize as expense. So that's why we have discrepancy. We have a discrepancy. The day we recognize as expense is different from the day we pay.
Yeah, my question is
Go ahead.
if just like if it's not real, like if you pay your salary on the first day of the month and you pay directly from your cash account to them, like the first day of the month, at that time, then do you still do liability
No,
account or
you don't have to.
You
don't
just
have to.
cash
Yeah.
and then
Yes,
expense,
you got
wage
it.
expense, right?
You got it.
Okay.
You got it. So if we change our story, okay, we happen to have the date on Sunday. Usually in real life, it won't not happen that often, okay. In reality, it's very, very rare, we match the day recognized expense is on the day we pay out cash. Usually it's not. Assuming, by the way, for this class, we assume we are all on the accrue method, not on cash method. For your story, if our business is on the cash method, then everything follow your theory. We don't do anything. Okay? For cash method business, usually we don't see payable account. We just skip this hustle. For cash method, for small business, in order to skip this hustle, we forget payable account. We all see already payable account is time wasting. It's totally wasting. We open this by the end of the month, and we close this 5 days after. It's totally wasting time, wasting the manpower, but we have to do it because there's accounting principle. However, in order to reduce our burden for small business, IRS even say yes, okay. For small business, you don't need to open or maintain the payable account. You do whatever on the day you pay cash. So we see the trick already, right? So for small business, payable account is not even necessary. We just forget it. Save our time, save our manpower. But for this class, we are assuming, even for some of you who never know, you never know. Maybe a few years down the road you become CPA. I'm not surprised. Eventually, I have a student, they passed CPA already. A few years ago, they never thought about this. But a few years later, when we meet on the street, in the shopping mall, we run into it, and we say, hey, how are you? How have you been for the past few years? I say, I become a CPA. No surprise, So you never know. Okay? So if you are going to take a CPA exam, no doubt you are on the accrue method. So this is why we need to do this hustle. We open our payable, we close down payable few days after. Okay, so do I answer your questions?
Yes.
Yes. So if you are cash method, you don't do this. When you pay out, okay, you reduce your cash, you recognize your expense. You don't pay out, you don't recognize your expense. They're easy. All right?
Yeah. But I'm thinking about that case that.
You mean cash method?
No, you
accrue
mentioned
method?
we doing a lot of hustle and using temporary accounts.
Yeah, the payable account.
Yeah,
Yeah.
because the times matter.
Yeah, time's the matter, right?
Yeah. But in that case, that you mentioned, the company delivered
The goods, yes,
and the payment postponed for the future.
right.
And my question is, in that case, because you have to do a temporary account, time is matter.
Yes.
I thought you gonna use the earned revenue at the first time, and after that, the future postponed time, the company receive the money, they then use the revenue as an account.
Right.
What?
So that's why I suggest you can do the research on the recognition, okay? Because that's same thing. Recognition happen to the revenue, also recognition happen to the expense. You want to find out what's the earnest time you can recognize the day you report this as expense. So can you give us example? You have a confusion. You have any confusion. So by the time, so for
Because
example,
as a manager of company,
Yes.
I'm trying to use this report, how much money, how much actually capital I have to invest in something. And when I put something that not really in my account in the bank.
No. Probably I can solve your problem. I try to repeat his concern. Okay, he said, go back to the very original case. Okay, when your company receive $1, $10 prepay from somebody else, okay, you receive $1,000 cash. You already deposit in your bank. However, I don't feel comfortable because I cannot report this as revenue. This is my obligation. So I believe really his question is, may I use this $1,000, or I have to keep that in a trust account or deposit account? I cannot use it. So I believe this is your concern, right?
No. That case, actually, I delivered the
No.
goods.
How about
People-
not deliver yet? If you deliver, I think there's no problem.
I think his question is when you switch to the other. Remember,
Yeah.
you said now you're the supplier,
Okay.
and you delivered the goods.
You have not received anything yet.
And
Yes.
Yeah.
Actually, so
No.
in that case, is he has the money in the account receivable,
Right.
right?
Right.
But it's not in the bank, really not. In
Of
the
course,
bank, it's
right.
Physical.
But we put that amount in the revenue.
As a revenue.
Yeah.
As a revenue,
Yeah.
right.
So he's saying why is a revenue and it's not an unearned revenue,
Yeah,
right?
well, it's
Okay.
not
Okay.
After that,
Right.
And the answer is because the goods have
I know
been
that.
shipped, right?
It's more like you are the lender for that situation. So if everybody get clear, okay, the situation. Right now, your company deliver $800 to your customer. You report this as revenue.
Yes.
So by the end of the bottom, you know you earn say $200, $300 already. However, the money is not in your account.
Yeah.
So it does not make sense. If you recognize as a revenue, you recognize net income already, you're financially, you should become stronger. If I put this just layperson language, your company should be, you become stronger because you from 0 to 300 net income. However, that's not true because I don't have a $300 increase. Eventually, I have a decrease.
Yes.
My cash basis eventually decrease. If I want to do any kind of investment, do any kind of purchasing, I cannot do it.
Yeah.
So how does that make sense? So financial report does not reflect the fact. Because if I read the report, my company should become stronger by $200 because I make profit. However, in reality, when I check my bank account, no, the money is not there. So how can this explain the situation? Anybody have your idea?
Is that because you're showing that you're selling, that the business is working?
Let me give you the hint, okay? There's a hint. If we want to make the whole thing justified, if we want to make this non-exist, justified or reasonable or acceptable, we base on assumption. We have some assumption. Otherwise, yeah, really, he's right. We cannot do this because the financial report fool people, right? Financial report really fool people because on the paper we say, oh, you have $800 revenue, then your cost of goods sold is only like $500. Your company should become stronger financially by $200. So you can use this $300 to do more purchasing, to do more R&D, to do more investment. But in reality, you cannot. Because in your cash account, you don't have such. So $300 is non-existing. However, if this principle or this report is acceptable, what is the assumption? There is assumption eventually. Eventually, there's a lot of assumption, to make the accounting principle acceptable. Otherwise, we don't agree. We do not agree. But this is acceptable. So you know why?
The assumption is that you're going to get paid.
Yes, we'll see it. This is big assumption, which may not be true. Which may not be true. However, this is assumption. Because as a business, we take a risk. We take it. So the explanation for Relic, yeah, you are totally right. Eventually this kind of discussion is the thing I like for this table. Eventually I tell you number 1, number 2, number 3, just memorize it and give me on the final exam. It mean nothing. I want to hear something from you, because you sitting here, you already find out it's not right. It does not right because on the report, my company is supposed to get stronger by $200, but I cannot do that. So you are right, but I can tell you the reason why we can flip around your inspiration or your observation, because there is assumption. Assumption is within 30 days or within the time limit, your company will receive this cash. So you just suffer for a few days, then you can turn around. So that's our big assumption. With the same token, by the end of the period, you do not receive this $800. You report as bad debt. We're gonna discuss bad debt for today. You're gonna write it off. You need to write it off because account receivable is assets, just like inventory. If the assets account becomes not worthy, no value, like inventory, right? Then you need to reduce your value. You need to write it off. But before we do that, we still assume you will receive that. You lose the time value. You lose the money time value. So you want to do some investment, you say, okay, you just wait for 30 days until the moment you receive it. All right? But if the whole industry is giving the same benefit, you don't lose anything. You understand?
Yeah.
If the whole industry, you give out the 30 days, but you also take 30 days from your vendor, your cash will stay in your account with the same principle. So even though you lose these $300, but you earn from somebody else, so your cash turn around, cash flow will maintain almost the same level as your payout cash. So that makes sense. That makes sense. All right. So yes, we're gonna go into our topic for today. Any input right now? Very, very good topic. Yeah, go ahead. Yeah, when we doing the, it's not you. You push down. Let me push down in the slide. Okay, we will go into our discussion for today. Okay, that's sales. We have a lot of issues to talk about. Okay, for sales. Let's see where we are.从4个 corner 啊，4个 corner. Okay, we will talk about. Let me see.
You gonna take a picture of what?
For the video. For the video. For the. This is Samsung, right? All right, we have sales. Okay, for today. Let's think about this. Okay. Assuming it's a crew method, right? So on the day you make sales, when we say make sales, mean you deliver the goods, okay? And it's more popular for retail business. We have credit card. We have a credit card sales. So for example, you recognize say $100 sales, okay? And you just recognize $100 as revenue. And by the way, we have a discussion, okay? If the sales is credit card, you will treat this as a cash deal or account receivable.
It's
How is you gonna do
it's
it?
cash, but you basically book the delta difference as an expense or a reduction in cash. Your choice.
Okay. So anybody else? Again, okay. My question is, when you deliver $100 goods to your customer, you are in retail, so your customer pay by credit card. So when you slide the card, right? Then you're gonna enter this as a cash or account receivable.
Accounts receivable,
Why?
because you still have to wait for the cash to come from the credit card company.
Okay.
Well, depending on the credit card company.
Yeah.
Some credit card companies do it fast, and some people do it slow.
Okay. Well, assuming right now in my situation, you receive the payment right away.
Oh, cash.
Right, of course, cash, right? If 2 days, probably account receivable. Okay? Okay, assuming it's credit to you right away. Okay? So the problem is, what's the problem for credit card sales?
Being declined?
No, assuming approved.
Oh,
There's a cost.
Assuming this is a good luck day for today, okay?
that's good.
Yeah, we have a luck day. Right?
The
So
fees associated?
yes, there's a fee. Assuming $2. Assuming $2. Okay? So how are you gonna do this? Everybody on the same page, right? We are doing the credit card sales. Credit card sales. How are you gonna do this?
It's like a
$100 the goods delivered. You charge $100. However, yeah, no problem. You receive cash on the same day. However, you only receive by $98.
Is an expense as well?
You want to do expense or you want to do the other way around? Which way you want to do? You can do either way.
Either way.
Either way. Okay, everybody. I hope everybody know what we're talking about. Okay, so when we say either way, you know what kind either way. Okay, so again, okay, the situation is we do the $100 sales, deliver goods, we charge $100, we only receive $98 from the bank. So you want to trade this $2 as expense, or you want to trade this only like $98 sales. Everybody follow me?
Yeah.
Either way. In our book, we trade this as $100 sales because assuming you don't receive on the same day. On the day you receive, only receive $98 cash. So you reduce $2 not as expense, as contra account to revenue. Either way will work. You still remember contra account, right? Contra account is opposite account. So you do this as a sales expense or banking expense, credit card expense, is fine. You just create another account. Okay, you just create another expense account. But usually in our book, the book does not trade it as expense because why not bother it, right? You can reduce one account, right? You don't need to create another account. You just reduce your sales by $2. So when you enter into $100 revenue, it's okay. But by the time you receive the payment, you reduce $2 as revenue reduced. Same result. But the good thing is you do not create another expenses account. Keep your accounting system simply. Okay, simplify. Okay, so this is one way. Another thing, very similar. Think about this. You do cash sales. You receive cash or account receivable, either way. But few days later, okay, within the same cycle, your customer return it or return partial. You deliver $100 goods to your customer, but few days later, for any reason why, legally, your customer return by $5. How would you gonna do it? Assuming this is a account receivable. Let's think about this. Okay, let's go step by step. So make it easy. Okay, you deliver goods, $100, account receivable. This part is easy, right? So this part should be no any argument. Okay, let's have $100 revenue. You just recognize, no problem, right? You have revenue here. What is that? Everybody, revenue. Practice.
Correct.
We have account receivable. Debit side is not down here. However, a few days later, your customer returned by $5. Return it.
So it's a
Oh, by the way, we should have inventory. Match this. Okay, assuming this is $8 each. Okay. Times 10. This is your cost. So when you deliver, you have a reduced by this and cost of goods sold. Okay, to make it more complete. Okay. All right. By the time you deliver this, you have this complete. All right. However, a few days after, if the customer returned by 1 unit, return 1 unit. So when you sold 1 unit is $10 each. That's your sales price. A few days after, your customer return, not exchange. Okay, just simply return it.
So on the revenue, it's a contra account.
$10.
$10.
Yeah. So I have a contra account here. It's $10. How about revenue? How about the revenue already? How about account receivable?
Same thing.
Same thing. How about inventory? Everything is reversed.
That's $8.
Yeah. Here. Come back here.
And
How about cost of goods sold?
same thing on the other side.
Okay. Everything reduced by the same amount. Okay. This is the function. This is the function we're gonna use on the contra account. Okay. To keep everything simplified. Everything is reversed. So by the end of the period, if you want to do the calculation, you just reduce by 1 unit. And everything straight out. Alright. Another example, very similar to this, okay, is account receivable. Okay. Say I have in a book. Okay, let's see this. Okay. You see this on your book. Okay. It's very common practice to do this. Okay. 2/10, comma, n/30. We need to know how to read this. Okay. N stand for net. Net 30. So either you're a customer or you're a supplier. When you read this, you know after you deliver your goods, there will be no payment. Okay, you wait for 30 days. Okay. However, encourage your customer or encourage you to pay earlier. So there's an incentive. If you can wait for 30 days. Big assumption is you will pay or you will receive. Okay, that is big assumption. You will receive or you will pay. Okay. However, in order to encourage the customer to pay early, so it's that if you pay within 10 days, you get 2% off. Well, 2% off is big deal because you only pay 20 days earlier, right? You can either wait 30 days or you pay on the 10th date, right? So you only pay 20 days earlier, but you earn 2%. So if you convert to annual rate, this is more than 30%. This big deal, big deal. And in today's day, there's no guarantee 30% deal. Then this is guarantee. So for the finance standpoint, you better off get it. You better off you get it. I want to get it. All right. So you don't wait 30 days. You pay on the 10th day, and then you can deduct the total amount by 2%. You want to do it. So go back to this example. Assuming there's no return. Okay, $100 account receivable. Okay. So for example, your company is supplier right now. Your company is a supplier. So you have $100 revenue, $100 account receivable. However, but on the day you receive the payment is only $98. Very similar to the credit card issue. So everybody want to try? Yeah, you can say adjustment or whatsoever. So
Contract.
you want to, Yu-Chen, you want to try it? So on the day your company receive cash,
Yeah. Okay.
$98. How are you gonna do it? You want to make everything balanced. So pick out the easy one, right? Cash, we have a debit 98.
Yeah.
All right. Then how do you make? We have a debit 98, right? So right now we need to make the credit side as 98. Everybody want to give the opinion? Yu-Chen, you want to give the opinions? So we have cash 98 on the debit side. On the day we receive, because your customer deduct 2%, $2 already.
So previously have already recognized revenue as
We
100.
we've done that already, so we need to do adjustment.
Okay, so you debit revenue to you credit account pay.
Okay, so I have yes. Hold on 1 second. $2 here. Everybody follow here so far. Everybody, you need to why? You should say debit $2 on the revenue because this $2 is another control account. We don't do expenses. This is not expenses, everybody. $2 is not your expenses. It's more like your revenue reduced by 2, right? So reduced by 2, so it's 100% correct. We have a control account here. So we have originally we have a 100 recognized, but right now when we receive cash, we say no, we do not. We should not recognize by 100. So we reduce 2. So when we reduce 2, we have a debit $2. Okay. And you want to finish or you want to give to somebody else? Anybody? Yiching, you want to? You want to? Yeah. Smart girl, huh? So Yiching, you want to do another one to close this deal? So hold on 1 second, Yiching. Okay, step by step. We have cash 98 already. Okay, on the debit side already. So we must have something on the credit side as $100.
You
want to try it?
You hit accounts receivable for 100 as a debit, so what you got to do is reduce the accounts receivable.
So you want to speak by yourself?
Oh,
You got it already. So, Yiching. Again, think about this. You need to pick out one account which can show you credit total $100. there's no expense issue at all. Everybody, help her. You are in the same group. You are in the same team. Yeah, you got it. You got it. Because we received already, right? It was account receivable for 100, and we. Can anybody tell me why we still keep 100 here? Why?
Because you booked it as a 100 to begin
Yeah,
with.
we need to close it down. No
You
reason
gotta
why.
close.
Even though we received 98 cash, we still need to put in $100 there. Otherwise, we cannot get it balance. We cannot put in 98 here. Otherwise, $2 must be somewhere, right? So when we close this, oh, by the way, everybody, again, to simplify the whole learning, okay? Anything payable, anything receivable, they are all temporary. The big assumption is we're gonna pay, we're gonna receive. This is our big assumption. So by the end, it's supposed to be zero. Otherwise, something must be wrong. In reality, it may not be zero, but somehow, in order to close it down, we must put in credit by $100. In order to put down the credit by $100, we must have 98 on debit, that's cash, and $2 also debit, that's contra account to revenue. Then we got it balance. Alright. This is the way to deal with this. Okay. 2/10, n/30. You guys got it? And I think that's not difficult if we, flip around, switch the position, put you as a customer. When you pay $98, you can do the same thing. Okay, to have the account balance. And we have another issue here is inventory. Cost of goods sold. We have another issue here. Remember here. Whenever you do the sales, you do the revenue, you do the sales. Not only you recognize revenue or cash or account receivable, that's one part, right? In the meantime, don't forget you need to do this adjustment, right? Because you deliver your inventory. So your inventory reduce, your cost of goods sold increase, right? However, we just totally simplify the whole thing from reality. $80, how can we recognize it? In real life, it's not that easy. In real life, the price change up and down almost sometimes every second. Not talk about every day. So when we purchase our inventory, we don't put in the same price. Okay? So there's the issue is called LIFO, FIFO. LIFO, FIFO. Last in, first out, or first in, last out, or you do the average. Okay, let me give you the example here, then we can do the more detailed discussion. Yi-Ching, is that okay? So we don't pick you out. We don't pick you out. We just want to everybody in the same page.
I don't think
So
she
you feel comfortable? It's okay, right?
No,
It's
I don't
okay.
think she understands.
I know that, so I will give her more opportunity. So this is why I ask. So you don't mind I pick you out, right? I don't. It's okay, right? Because I want everybody to try to help you, and we at least this is a very small size class, so I want everybody on the same page. So I know you are a little bit behind, but it's okay. It's okay as long as you don't mind I pick you out. Okay.
Let's pick on you.
Yeah. Yeah.
Well, I'd like you to go over that.
You want to do me again?
Yeah.
You want me
let's
to do it again?
Yeah.
Okay. I can do it again.
Do it again.
I can do it
Let
again.
her do it.
Yeah. Again.
Do the whole transaction.
Yeah. So yes, when we done each class, it's done. It's done. Okay. So even though I can feel you are a little bit behind, but as long as you don't mind, we can slow down. We slow down. I hope everybody will on the same pace. Okay. So go back to that situation again, step by step. Okay. Step by step. Okay. When your company recognize $100 sales, delivered $100 sales to your customer, you don't receive cash. You have a 30 days payment you need to wait for. Okay. So on the day your company deliver $100 of goods to the customer, of course you recognize revenue by $100. Okay. And the revenue increase is on the credit side. On the credit side. So I leave you alone. You want to match another account. You want to pick another account to match $100 on the debit side. Which account you want to pick?
Can I make a suggestion? Is erase the board, let her book the revenue to accounts receivable, then let her book the
Okay.
let her book the
Yeah, let's
transaction.
go step by step. Okay.
It's important that you understand this.
Yes. Yes. Because when today's gone is gone. So I hope when we finish this, you leave this room for lunch, you have much better idea what we talking about right now. Okay. Okay, Yi-Chen. Okay, here is the situation. Okay, your company deliver $100 goods to your customer. However, you don't receive any payment yet. The payment is 30 days. So you want to pick out 2 accounts first to record this transaction. Can you tell me what account you want to pick? You can speak louder, no problem. Confidently, okay? Confidently. When you do sales, you want to do what? You need help, you can ask your classmate. Get help. When you do sales, you do what? Revenue. This is very good. So in my example, this is $100. And when we do the revenue, you want to do on the which side? Debit side or credit side? Okay, everybody. Okay. I have the revenue. Okay. I don't put on debit credit anymore, okay? Because by now, you should know debit is on the left, the credit is on the right, so I don't bother you anymore, okay? So no problem. So far so good, okay? We have a credit on revenue by $100, and then you want to do what? Very good. Account receivable, okay? And okay, assuming you sell for $10 each unit, okay? This is the assumption, okay? And then we need to adjust your inventory, assuming your cost is $8 for each unit, okay? So you need to do inventory here, okay? But you want to do which side? Louder? Everybody can hear it. Not yet. Inventory is not cost. Inventory is inventory. Think about that. This is a very good exercise. Once you've done that, you learn that.
Can you repeat again?
Okay, you need to do your inventory because you deliver your goods, right? So obviously your inventory reduce.
Will be credit.
Nice. So again, it's $8 times 10. And to match this inventory is name. What's the name? Louder?
She's saying
Confidently.
it. She's saying it.
Yeah. So forgive my ear. Okay. Cost.
Cost of sales, right?
Yeah. Cost. Yeah. Then tell me, debit side. Yeah, good, very good. Assuming number 1, okay, return. Not come to the payment yet. Return if number one situation, your customer for any no reason but legally return by 1 unit to you. When you receive the return, you want to do adjustment here all the way back, reverse back. Yeah, so we do the revenue reduced by 1 unit is $10. Okay, account receivable reduce, and inventory increase because return you increase your inventory. Maybe $8 there. And your cost of goods sold reduced $8. So yeah, this is a reverse when you receive the return. Okay, let's wipe it out. Okay, assuming no return, everything going so well, no such return. All right, over here. Okay. However, you have a net 30, but 2/10. That means if your client pay within 10 days, pay 20 days earlier, they reduce by $2. So they did that. Okay, they just pay you $98 within 10 days. So you only receive $98 cash. So on the day you receive $98 cash, what will you do? No, you can do that. You can do that later on. Okay. At this moment, I want you to do cash first in order to avoid confusion, less confusion. Okay. So right now we receive cash, right? So how are you gonna do cash? On what? 98 we know, but on what?
How much cash?
$98.
Oh, $98.
Debbie Evan, right? Okay, next step. You have another 2 accounts you need to pick.
You gotta get rid of accounts receivable.
Hold it. Hold it.
You gotta get rid of all accounts receivable.
Yeah, you need to close down this account. In order to close down account receivable, you need to put in how much money? Again, you need to close this account. Totally close down. On. Yeah, good. So you close down. When we say close down mean, okay, everybody, when we say close down the account mean same amount on each side. The balance becomes 0. That means close down. So it cannot be $2. $2 is not here. It's somewhere else, but it's not here. So you just said, wow, credit $100 for account receivable. Only by then you close this account down. Then right now we talk about $2.
So you're out of balance for $2. What are you gonna do with it?
Right.
How are you gonna get in balance?
So $2 where you want to put. Right now we're talking about $2. You mentioned it twice already. No, you only received 98. So cash we done already. Okay. Another hint for you, okay? $100 on the credit side, $98 on the debit side, so $2 must be on debit side. Debit side. So we know by the end of whole transaction, by the time we receive $98, cash increased 98. Account receivable totally closed down. However, revenue reduced by $2. So the net revenue is 98. Net sales for this transaction is 98. Everybody agree so far?
Yeah.
Go ahead. Everybody agree?
You don't know it yet. You're gonna really study this. You don't know it yet.
Yeah. So I think this is good progress. Okay. This is very good progress. Everybody, when you go home, I'll give you the video. You just practice over and over again. This is a very, very simple example, but it's very fundamental. Very, very fundamental for you. Again, I do not expect everybody to become CPA, but again, after this, session, we use the same language. And wow, we're talking about what's a debit credit, what the heck it is. We know what it is, because that is the language we're going to use to communicate. Okay. So we have a little bit of time. Talk about the inventory. LIFO, FIFO. Okay. LIFO, FIFO. Okay. It's here. So remember I said here, right? When we do the inventory here, we just simplify everything. We're assuming it's $80. But $80 is not easy to come out, okay? The reason why is in real life, we don't purchase our inventory in one time. We maintain our inventory on the continued base. And the price, if not change every day, it change. So the problem come out like this. Say, for example, let me wipe this out, okay? I'll give you the example. So there's one inventory here. We purchase on a continued basis. Okay, say inventory X. We acquire the first day. We buy this $10 for 100 units. The next day, it went out to $12. We purchased 200 units. The other day, it dropped to $8 for no reason, okay? And we purchased another 300 units. Okay, this just gives you very, very simple. In real life, it's very, very complicated. Here, forget cash deal, account receivable. Okay, that is not the issue right now. The issue right now is how to calculate our cost of goods sold. How to identify the value of the inventory we deliver, the value of the merchandise we deliver to our client. Say, for example, in one deal, in one transaction, we deliver 500 units. 500 units. We forget about average, okay? We don't talk about average. Average is easy, a lot easier. We just use the average, okay? But right now we're talking about either FIFO. FIFO means for this transaction, we deliver the 500 units from 100 units, 200 units, and 200 all from the last shipped inventory. So 100, 200, and 200. That's called FIFO. Okay. First in, first out. So if on day basis, our cost of the inventory is 1,000, 2,400, and 1,600. Everybody got it? This is called FIFO. If we will use a LIFO, then just 300, 200. We always keep the very first in still there. Well, physically, by the way, everybody, physically we may move the inventory we first purchased out. But for accounting purposes, we use the number lost. You see the point? Okay. So in this case, we use FIFO. So discount 1,000. Discount 104. We have 200 from this inventory. This is 16. So if we use the FIFO, we have $4,000, $5,000. This is FIFO.
That's for how many units? For
500.
for 500.
So for example, we have a 500 unit
Oh, okay. I see.
delivered.
I see.
All right.
That's 226.
Am I right?
Yeah.
The number correct? Okay. If we use a LIFO, last in, first out, we have 2,400 here. Plus 24,
And that's it.
48. So we have a discrepancy here, but that's allowable. That is permissible. As long as you keep this constantly. You don't change that. You don't manipulate. Okay? You don't manipulate. You just, for any reason, you want to stick with one method. If average, use the average all the way down. FIFO, always keep the FIFO. LIFO, keep always LIFO. And make the whole thing more complicated. In one same company, you can choose different method on different items if you really want to. I don't know why. Okay? For any reason why you don't want to keep this a FIFO and the other one is a LIFO, you just keep it constantly. They'll be fine.
She pointed out that your numbers are actually wrong. It's 16. It's actually 800 times 3 is 20.
300 is not.
No, but you
No,
only
it's
need
not.
200 because it's 500
3.
units.
You only need
Because your FIFO, you only need 500 total, right? 100, 200, 300 already. You just need 200 from here.
So what the 500 units come from?
The
Order.
deliver, you need to deliver these sales to your customer.
That was the example.
You obligate just for these sales, you only need to deliver
Oh, you
500
only-
total.
You only need 500.
Right, 500.
Okay,
Right?
thank
So
you.
you use a FIFO, 100, 200, 200. Okay? If you use a LIFO, just 300, 200, you're done already. So you see, there are $200 discrepancy. But as I said, it's permissible. It is permissible. So you can see, if you choose this method, your net income compared to this reduced by 200. But there's no good and bad. There's no good and bad. For investor, you want to have a higher profit. So for investor, you want to show this number. But there's no guarantee. There's no guarantee. For tax saving, you want to reduce your net income, right? So there's no good or bad. Really depends on what is your purpose is. However, for accounting principle, this is permissible. And the issue is you keep it there constantly.
But it's easier if you use average.
Average is a lot easier.
And then
Lot easier.
variances.
Let me tell you what. Okay. Let me tell you what. I think up until right now, for accounting financial statement, within the limit, you understand. Legally speaking, we can manipulate. This is one example. Manipulate, right? You want to do something for your benefit, for some purposes, right? So, if you use average method, there is no manipulation because everything is average. So sometimes you don't want to use average, even though average is simpler and maybe more accurate. Maybe more accurate. Maybe I would say, but you lose your ability to manipulate. So this is the funny thing for the financial world. In one side, the law or principle allowed manager to do some kind of manipulation, but only within the limit. So I believe the class for this is to learn what's the limitation, what's the line we cannot touch. But here we know that the FIFO LIFO is permissible.
Well, wait a second. Your numbers. The first one's 10, which is 1,000. Second one's 12, which is 2,400. The third one's three times, because it's 10, 20, 22, so you're short 3. So it's 3 times 3 is 9. So it's 900, not 600.
Which one?
1,024. The third number.
This is a 1,000, right?
Yeah.
This is a 24, right?
Right.
Am I right? Well, here you only need 200 to
You need
deliver.
3. You need 3. So
Because total is 500.
500 units.
You only need to total deliver 500 from this deal. Got it?
oh,
Got it? Right. For this transaction, you need to deliver. So
That's
on
it.
purpose, I pick up 500. If I use 600, it will be fine. It will be the same. If you need to deliver 600, either way we're the same. I just on purpose I say you only need to deliver 500. So 100 here, 200 here, only 200 from here. Right? So this is a FIFO. So FIFO calculation is 5,000 as a cost. If LIFO you use the 200, 200, that's it. You got enough. So if you use the LIFO, your total cost is 48. I pick up 500 on purpose.
Okay.
I can pick up 450, I can pick up any number. But 500 to cover 3 shipments. Okay? So I just give example. It is permissible for your inventory, for your cost of goods sold. But for no, you cannot guarantee which one is better or worse. You cannot guarantee. Once you choose this, you just need to stick with. While if you want to change that, you need to get a permission from IRS. Usually IRS will say no. They will not allow you unless there's a very, very specific reason. Sometimes involve the company merge, the company merge or spin off whatsoever. Very, very special reason. Otherwise, they will not.
They will not allow you to what?
They don't
Convert
allow you
that,
to
change that.
Okay.
Yeah,
Unless
you
it's
found
a-
right. Yeah.
Unless it's to their benefit.
Yeah, that's beyond the limit. As I say, the manager try to manipulate, but this is beyond the limit. Okay. All right. Any questions for so far? You are go ahead. Yeah, go ahead.
If any company decide to change the people before, it have to wait at least 1 year after closing the books.
Well, the answer is usually they cannot change. They cannot change the method.
But you mentioned they have to, the company can ask to the IRS to change the.
Yeah, they need to.
You write a letter.
Yeah, you write a letter and get a permission.
But the question is, how long does it take?
No, they change it from the future. They keep it the way it was before. It had been done. They cannot change it, but they can change in the future.
But the future, you mean the next month or you mean
Next year.
Next year.
Yeah, from the approval letter. Yeah, but this very, very rare. Okay, you will have a homework finally because I say I'm thinking about that. That is I will email to you. Okay, this is this one. It's a kind of long one, but it's more complicated. It's in your book 368. By the way, I use the newer edition provided by Debbie. Really appreciate. So maybe it's the same one, but maybe not. Okay, if not the same one, I will email to you. It's on the page 368, but this is the edition 7. So I'm not quite sure it's the same as the 6th edition. But anyway, I'll email this to you. Okay, this is complete one. So you need to do this E7-7. There are 3 questions you need to answer it. Shouldn't be very difficult. This is a LIFO FIFO issue.
I got the book from Reskin, by the way. He passed it.
There is a free.
Yeah.
Yes. So if anybody need that, we can email to you, right? Okay, so this is due in 1 week. So you just send email to me, okay, tomprofessor@gmail.com by 6 p.m. next Sunday, July 20th. Okay, July 20th. So assuming you are so busy for the whole week, you don't have excuse on Sunday, right? Sunday morning you still can do it, right? So due date is 6 p.m. afternoon. So email to me. Okay, do the exercise.
Two problems or is
No, only one. 7 days 7. That's it. Don't do any other thing.
7.
Just do the 7 days 7. Okay. You answer those 3 requirements. You do your homework. You do on the spreadsheet or whatsoever you like. You just email to me. Okay. Another reminder. Okay. Reminder. You need to go ahead, prepare your final presentation. Okay. It's not too early now. Only month and a half. Okay. Like 30 days. It's not early. Okay. Just go ahead to do it. Any input? Any suggest? Any puzzle?
one
Yeah, go ahead.
one option for the final was a section 178.
Yeah, 179.
179.
This is a very good topic.
Then another one, recognition of
Recognition.
revenue.
Yeah,
Those are
revenue or expense.
The two that or expense.
Yeah.
Those are the
Or
two.
you just want to say, I want to compare the cash method versus accrue method. This is way easy. I think this is too easy. I think 179 is worth it to do it because it's very useful for your business, your own business, and also recognition. It's a good thing. Yeah.
We're going to do a PowerPoint on this. How long? How many slides?
15 minutes. You can do whatever you want.
Okay.
Yeah, whatever you want. You only can have 1 slide or 100 slides. as long as you finish in 15 minutes. Yeah, I think we're gonna use this classroom. Yeah,
We're going to actually do the presentation.
yes, with this. Right. Yes. Okay. Okay.
And more than one person can work on the same topic.
If you want to work together, they'll be fine. I don't mind. But each person you come out, split 15 minutes. You cannot have another people on behalf of you to do your own presentation. Okay, you can do the group work. This fine, but you do your own part. 15 minutes.
No, my question is if me and Robert decide to work on 179.
They'll be fine. Everybody you share 179. I don't care. You just need to use your own slide. You don't share slides. They'll be fine. Yeah, they'll be very interesting because you may come a different conclusion, right? I
I
don't
think
mind.
it's the same E77.
Oh, that'll be fine.
It's just 378.
Yeah, luckily it's the same. Right. So Robert just check. Okay, it's the same page on this
No,
sixth edition.
no, it's 378.
378.
And
Okay.
that one's 368.
Okay.
Yeah.
Because the stage 7 is the same, right?
Right.
Different pages. Yeah. On sixth edition is 10 pages more. Yeah, that'll be fine. So enjoy your World Cup. Which team gonna win? Everybody beat?
Argentina.
No. I mean today. For today.